fellow investors. This video is requested by one of our subscribers. He particularly wanted me to look into NIO, but I thought I'd screen them all at the same time. China's three EV companies, NIO, LI, and XPEV, the thorns to Tesla's growth story and to the moon shareholders. I'll just pull up this delivery update, guys, very quickly for these three companies, just because I want to address that this is no longer a concept. This is business already. A working one, a solid one, probably sustainable, hopefully. They've designed, manufactured, sold, and delivered these products. That's all I need to know. How much of these numbers are true? I don't know. It's your job to find out. What happens between now and the growth story depends on the marketing, competition, and of course the consumer demand. Do they like the car? Is it from NIO, Li Auto, or XPeng, Tesla, BYD, other car manufacturer, one from each? Do they really want an EV or just another gas car? I don't know anymore. And that's where the financials come to play. The more players in the industry, the lower the prices, the lower the margins of these car companies. That you should expect, or they'll end up losing market share if they continue selling at very high prices. Unless, people are okay buying expensive, like in the case of, Louis Vuitton, these designer brands. Well, at least that's how supply and demand work, right? This is their financials. I can pull up a decent valuation summary because they only have 3 to 4 years of financial data. I'm using Seeking Alpha's numbers here. So if there's anything wrong with these numbers, this is in USD already. Let's first talk about NIO. This is their revenues in billions of dollars, USD. This is their revenue growth. Very impressive growth. This is COGS, or cost of revenue, cost of goods sold, whatever you want. And this is the amount of COGS in percentage. This is OE, or operating expenses, and below are the OE margins. I do this deconstructing of their revenues to have clarity of how much is allocated or spent to COGS or OEs, or overall expense, and what's left of the company as profits. I did this with Palantir, and I came up with the margins we'd pay for the stock, which is 15 to 25. From there, we'd apply my process where I pay 1 PE, or 1 multiple, for 1% of their margins. We do the same thing here. We look at a possible multiple the stock should be trading at. NIO is unprofitable because their expenses exceed their revenues. If you add the percent COGS plus the percent OE, it should yield less than 100% for a company to be profitable. Plus or minus some tax there, obviously, probably around just 2 to 4%. What you're left with should be the profit margins or the free cash flow margins. In NIO's case, there's nothing here except this one in 2020, free cash flow margin of 5%. Obviously, this does not tell a lot. One data does not define whole, but it kind of opens you up to the idea that maybe they'll only be able to come up with just these margins. For traditional car manufacturers, the operating margin is only around 4 to 8%. Operating margin is simply the revenues less all expenses but the taxes. So operating margins, if you take out the taxes, you'll get the profit margins, and hopefully, if the accounting rules work fine, you get the same numbers as free cash flow margins. Again, traditional car manufacturers only have 4 to 8% operating margins. This is why you see them trade at very low PEs. Look at Ford, Toyota, GM, other car manufacturer. All because their margins are very low, and investors shouldn't really be paying a lot for those kinds of stocks. Now, when EV came in, a discussion whether or not it should be valued like tech is suddenly on the table because there emerged margins like Tesla's, or in this case of Li Auto's. If you look at Li Auto's margins here, they at one point reported margins of around 18 to 26%. Now, obviously, this is all good, but is it sustainable? Can they do this number over and over? That's the question. Can they, and I mean the EV companies, deliver margins like double or triple those of the traditional car manufacturers? If they can sustain those kinds of margins, then yes, investors should be open to the idea that maybe we should value them like a tech company. Again, guys, this happened in 2020 and 2021 when money was essentially free or cheap, and now obviously more competition is coming, and those margins at one point will reveal their true selves. So for now, I think the market should value them for what they currently are and not what they hope they'll become. XPEV is unprofitable as well, so meh. This also explains why Li Auto chart held up better than NIO and XPEV. NIO and XPEV are breaking down, while Li Auto is only trading sideways. Because investors have these numbers that they can use to value the company. while the others remain in the speculative area still. Another way to look at this is their gross margins. Traditional auto manufacturers have an average of only 25% gross margins, meaning the COGS or the cost of revenues or cost of goods sold is around 75 to 85%. This takes a whole lot of their revenues, right? If we look at these Chinese EVs, the lowest I see here is 78%. Highest is 100 plus. That means it still falls to the same category of the traditional auto manufacturers. That's why the idea that it should trade like the Fords, the GMs, the Toyotas is there because they're no different, at least not yet. Maybe their revenues have not grown enough to show the real gross margins, right? That's a possibility. Now let's go to what price I'll be paying for these EVs. Well, first I want to say, just by looking at this, I think there could be more value in Li Auto than NIO and XPEV, but I'm liking NIO more on the market share side of things, looking at their revenues. Just the margins is what concerns me. Now, how much would I pay for NIO? Again, I can't make up much with their current financials here, but if we refer back to valuing it like your traditional auto company and the margins in 2020 kind of agree with this, then I think NIO should be having margins of 4 to 6%. That means I'd be paying $4 to $6 for NIO with the assumption of 1 EPS. Again, being unprofitable, they'll still be diluting shares going forward. 1 EPS is rich for the stock. Meaning, at $4 to $6, you have to be open to the idea that the stock is still expensive. Now, can we attribute that to the growth potential? I mean, sure, it's growing, right? But how much are you willing to pay for that growth? If I'm sticking to my process, I'd be buying NIO for $2 to $3. That price, I know I'm still overpaying. I'm still paying for a growth multiple, and that is to say with margin of safety of 60%. That's my risk for 1, the stock being unprofitable, 2, the risk of China, 3, how credible or accurate are the numbers I'm using. I don't even know. Add the FX issues, all those things. I want to discount from my fair values. Again, $2 to $3 is still overpaying. I'd use the same with XPEV. That will be my entry price for the stock as well, $2 to $3. About Li Auto, with these numbers, the assumptions I use here is Tesla's margins actually, 10 to 14%. Why didn't I use the same assumption to all? Well, one, they're different companies. Until they prove to you that they're worth paying 10 multiple or more, then why not? But so far, only Li Auto gives me those margins. Why didn't I use 26 or 18? I didn't use 26 because they reported an 18. Maybe 26 was an anomaly. It happened in 2020 after all. About 18, I want to discount some, but not so much that it would lose the essence of their previous numbers. 14 actually was Tesla's highest margin, or multiple for that matter. And because of this video, I'm now looking at Tesla that maybe I should up my multiple to maybe 12. Not just 10, maybe 14. That said, my entry prices for Li Auto could be around $5 to $8. These prices are not accounting for a lot of growth and share dilution, but at these prices, you'd still be overpaying and you're still buying the growth story. This process of breaking down revenues would bring more clarity if they had reported more numbers. The fact that you're invested in this early, I hate because clearly you overpaid for growth. Yes, at some point, these companies will be valued more as time reveal what they are. But when that time came, you could have just opened a new position and not DCAing into the stock. The goal is not to break even. It's to make gains. I hope you just traded these stocks because it's hard to tell whether or not they'll meet those revenues to profitability, especially with the growing competition and tightening monetary environment. With these 3 companies, maybe one will only work. I don't know. But if we look at US manufacturers, then a lot of them went bankrupt. That's a possibility for all these EVs. Generally, auto manufacturers trade at low PEs because they have low margins. If EV can sustain triple the margins that the traditional autos make, then yes, EV should not be valued like the traditional ones. Of the 3, I like Li for their financials, I like NIO for their revenue growth and market share, XPEV, meh. That's my take on these 3 Chinese EV stocks. I didn't go through their equities, the nitty-gritty of their financials. Auto manufacturers don't trade on PBs anyway, they trade on PEs. So this is just making some sense of their financials. Maybe use these multiples and pair them with analysts' estimates and your assumptions. Maybe you'll get or come up with a much more reasonable entry price. But if I have to stick with my process, I wouldn't even dare touch this stock, even if I get my entry prices. I mean, I could have easily made money with Baba, but I didn't. I cannot touch the stock. I just can't because of the risk of China, and just investing in any Chinese stocks just doesn't sit well with me. That's just me, guys. You don't have to follow me on this. I hope you found value in this video, and if you did, help me with a subscribe or a like or a comment. Maybe join our Patreon. I give swing trade ideas, fair values, and more exclusive content. Visit the page for more info. See you next video.